Okay, so we are starting, right? So, hello everyone. So, this is in this session we will discuss about mental models and frameworks which are used by investors on a day-to-day basis. But starting on, we will start with the India story, some things regarding that, and we will also explore some other concepts in investing, how the investing landscape is currently changing, what are the economic shifts that are happening these days, and ultimately, which are the strategies for identifying strong multi-bagger stocks or companies. So, I've not structured well this talk, and at any moment, if you have any doubt or if you want, like, if you disagree with something, you can definitely like share that thing. So, So the starting we will do with the change how investment ecosystem is changing. So the actually the last decade in investing is all about quality and consistency. Last decade I means 2010s, 2010 to 2019. So all the businesses that did good, they were quality businesses. What do I mean by quality businesses? They have high return on capital. They generate high return on capital employed. In crude terms, this means that if you employ 100 rupees in your business as capital and if you generate 30 rupees profit, that means that your return on capital is 30%. So the more you generate on the employed capital, the return you generate on the business, the better quality the business it is. Also, consistency in business. Consistency means how consistent are your profit margins and cash flows. That was rewarded. But these basic theories they remain true with time, but they have changed a little bit, especially after post COVID. And after post COVID, the stock market is in a linear trend, going up and up every day. So this creates some sort of confusion in people, like that stock market can never fall. But actually, as market cycles are there, and as stock market is there, and as life is there, everything is cyclical. So you will face up and downs in life. Similarly, you will face up and downs. You will face bear markets also. And there will be bad business cycle also. There will be good business cycle also. So the changes can be first broken down what happened after 2016. So anybody remember what happened in 2016, 2017 period? Anybody who remembers what happened in 2016 and 2017? So in 2016, basically November 2016, PM Modi did demonetization in India, and 2017 GST was introduced in India, and this completely changed how businesses operate in India. And obviously, if businesses operational their changes, so obviously investment ecosystem or investment paradigm also changes. So what were the key events like, and what were their impacts? So first was obviously demonetization. So what led to this? One of the ripple effects of demonetization was that there was much more formalization in the economy, and the efficiency in the economy increased. So money moved bottom of the pyramid. Why? Because government launched direct benefit transfers. In direct benefit transfer, you transfer money directly to the bank account of the people. And all this jam trinity that we talked about, Jan Dhan, Aadhaar, mobile, through which UPI payments are possible today. Everyone, even a rickshaw driver, is accepting payments through UPI. That was possible through the jam trinity, which was started when government started making Aadhaar cards in 2014. But when this was happening, after this that, there were some problems in the economy, uh, especially with NBFC companies and PSU banks. So these PSU banks, you remember at that time, 2016, 17, 18, you must have read so many of news like PSU banks getting bankrupt. Matlab, people are people like Mehul Choksi or Vijay Mallya. Nirav Modi, they were taking thousands of crores of loans and they have defaulted on their loans. They fled outside India. So there was actually a downturn in the banking sector, and this led to a credit-led crisis in the economy, similar to what happened in 2008 in America in the Lehman crisis. So all this, what it leads to, that there was a downturn in the economy, and you must have remember that there was a new YouTuber that came into India called Zavrati, and he was like criticizing Modi government that they are mismanaging the economy. But the main reason was this: it was a banking led problem which started at the UPA time because there was reckless lending done at that time, politically motivated, through which bank lost a lot of money, and that led to a economic crisis sort of thing in which the economy was growing at 4 5% annually. So what COVID did? So COVID, people shifted away from real estate to everyone came to the stock market because during COVID every business was closed, but stock market was functioning, and there was a lot of retail participation that increased in the market. Or most of the retail investors who are investing today, I think 60 70% entered in the COVID period only. Financial influencers on YouTube, educators, they were providing information. They democratize information about financial markets. So kind of pandemic movement was, and there was these discount brokers available like Zerodol. So opening demat accounts was easy, and investing was easy, and information was easy. So all this led to a democratization in financial markets of India. So what happened after that? So what COVID happened? So world over there was economic crisis because businesses were not functioning. So what do you do in an economic crisis? This is basic economics. Is that during a recession when when there is no demand because people are not consuming because they are not earning anyways. So what do you do? You have to like responses that government make. One is that in order to boost the demand in the economy, you either provide fiscal stimulus or you provide monetary stimulus. What is the meaning of that? Fiscal stimulus, monetary stimulus basically means that you directly give money in the pocket of the people. You directly give money in the bank accounts to the people, right? So that the demand can be artificially revived in the economy. In fiscal stimulus, what you do, government starts spending more because if you know the GDP, the formula of GDP is basically it is consumption plus net final consumption plus government spending plus investments plus net exports minus imports. So either of the variables have to be increased if you want to increase GDP. So the fiscal stimulus basically means government start spending more. So government spending increases, so GDP increase. And this fiscal stimulus basically uh, means government start investing more into the economy. And fiscal basically means fiscal deficit. You must have heard. Fiscal deficit means the difference between the budget of the government and how much government is spending. That means that there is a net deficit created in the government that is financed through loans, debt. So it is the theory is that you in during recession times, government should forget about fiscal deficit and all, and should spend more and more in order to revive the economy, so that demand can be increased in the economy. This can be done in various ways. One way is increasing the money supply. That is also called as quantitative easing. And basically printing money and increasing the money supply. This is basics of Keynesian economics. If you study Keynesian economics, which was given by Lord Keynes, so he basically talked about this that government can do quantitative easing, something which basically means increasing the money supply in the economy, and this will increase demand, and this will also increase production because if there is more pent up demand, then producers will start producing more. So this is a theory. So worldwide, what government did in this COVID situation, they basically gave a lot of monetary stimulus instead of fiscal stimulus. What does it mean? That, for example, in America, if you have been, so most people were getting stimulus checks, which were $1,000, $2,000 per person per month. They are getting in their bank accounts. India, we didn't do any of these, but we did the second thing, which is called fiscal stimulus, which was given in by the government. And what government did was that three things that government did. One was government gave free vaccines. Second, they give free food. So this 5 kg ration scheme that was launched actually in the COVID time only, it is continuing till now, although. So, and they gave Manrega, they increased Manrega scope. And the last thing, the most important thing that government did in this period was investing a lot of India's capital infrastructure, or the infrastructure of India. So making more and more roads, bridges, these sorts of investment government did. And what does it leads to? Interestingly, the government, Indian government, focus on providing fiscal stimulus and infrastructure stimulus, capex led. It leads to economic growth and investment in the economy. So temporarily at the COVID time, it was feeling wrong, but when the economy revived, so all the economies worldwide, they were facing a lot of inflation. So as you must have heard, in 2021, 2022, USA was facing around 9 to 10% headline inflation. And in country like America, where inflation is like 1 to 3%, facing 10% is imagining in India if inflation becomes 40%. That's kind of scenario was there in US, and that's was a lot of like talk happening. And Russia Ukraine, this was the main thing, concern of US was inflation. So, but India, we didn't face that kind of inflation. The reason was that government did not did basically give monetary stimulus, because what monetary stimulus give, it increases the money supply so much that basically the value of money decreases, and ultimately it results in a lot of inflation. For example, think in that sense, like every person around you is, if government gives them money and they have a lot of money, and if the production goods production is like same, in that case what will happen is that there will be a lot of demand, but there will be less supply, and simple demand supply of economics tells us that prices will increase, and that was basically happens. Inflation basically kicks in the economy. So, what governments around the world basically forgets one thing is something called as higher order thinking. Higher order thinking is basically second, third, fourth order thinking. Basically, what this means, for example, we think that if we did something, let's suppose we take action A, it will lead to action B. This is called as first order thinking. But second order thinking is what? If A leads to B, what will B leads to? Basically thinking about consequences of consequences. Action has a consequence. If you think about the consequences of those consequences, that is called higher order thinking, or second order, third order thinking. The more you think in those terms, more abstract terms, that is basically higher order thinking. And basically government forgets about this. And to this, I have an interesting story to tell, which is related to Cobra effect. So what happened in India in the 18th century, when Britishers were there governing India? So 19th century, when Britishers were there, in some areas there was a problem they were facing, that there were a lot of cobras and snakes in their territory. So one person advised them, "Okay, hey, how to reduce these snakes? You these He said that, okay, these Indians, these brown bloody Indians, these are very like greedy people. You, you announce a bounty that on snakes, that whoever catches and kills a snake, he will get money, right?" That was the scheme that they launched. So they launched bounty for these snakes. So ultimately, as the scheme rolled out by the British government, then the population of the snakes initially they decreased, but after some times the population came back to the original level which was existing before starting this scheme, and then population of snakes started increasing more and more and more, even more than what was the initial population we started. And then these British people were so perplexed and they confused that what is happening here. So they called one ICS officer, basically Indian, and they asked their advice that why this is happening. So he told him, basically the Britishers, that actually these Indians, what they are doing, they are very smart people. They have made a whole industry out of your scheme. So Britishers said, what type of industry? They said that they started rearing snakes, and so that they can kill them and then give them and take the bounty rewards basically for catching the snakes. So instead of catching the already snakes in the ecosystem, they started introducing new snakes, and that's why the population of snakes is reducing. And after that, the Britishers got so angry, they said that cancel this scheme straight away. Nobody will get no money now. And what happened? All these snakes that were reared, they were like thrown away in the open ecosystem, and now the population of snakes was so much. What did we learn here? That here the Britishers hasn't thought of the consequences of the consequences. Basically, they thought that okay, if we announce this scheme, people will give us snakes, so snakes population will decrease. But they do not think of that what will be the people's like response in this situation. And basically this is called second order thinking, that you think of consequences of consequences. So here in this situation in COVID time, what government have not thought about is that after this, because of this pent up demand, inflation will will be very much there. So there's so a lot of sectoral shift that happened during the COVID time, because Indian government spent a lot of money on doing capex and infrastructure. The first was investing on defense. So Indian defense budget is actually 2% of GDP. So for example, if India's economy earlier was $2 trillion, means $2,000 billion, to 2% of that amount is around $40 billion. Out of this $40 billion, which was defense budget earlier, uh, more than 15 to 20 billion dollars was straight away going to purchase defense equipments from outside countries. So actually we are like importing 20 billion dollars of defense every year. That was the situation back then. So what then the, and actually not just, this is not just buying basically defense equipment. One more thing, when you get into these types of contract, is that you get into annuity contract, in which these companies who sell you defense equipments, American companies or French companies or whatever, Russian companies, they sign these contracts, and so that they will do the repairing and maintenance also, and they charge also for that. So not only we are giving 20 billion, we are giving even more money to. So what government did in the Atmanirbhar Bharat scheme, basically, that they started to indigenize defense production in India so as to substitute the imports that we were doing. So this suddenly means that today's economy, which is like $4 trillion economy, if 2% is our defense spending, which is approx that, $80 billion is our defense budget. So $40 billion now, which will be the capital infrastructure investment in weapons, etc., technology, that will be utilized by the government. That will not go. All the money will not go to the foreign companies. It will now come, a lot of that money will come now in the Indian defense manufacturing sector. And defense, which was not even a sector to be considered in the Indian investment game, suddenly becomes a sought after sector. Like now, if you see, there are defense schemes also, defense schemes in the sense, defense mutual funds and sectoral funds, and focusing on defense companies. A whole industry has like emerged, and that's why in the last 3 4 years, defense companies have given like 5x, 6x, 10x, 20x, 100x the returns companies in the DM. What was the reason? Was that a lot of spending done by the government. Another some sectors like electronics manufacturing, the whole EMS schemes, PLI schemes, they introduced this new sector in India called as EMS sector, electronic manufacturing sector. So a lot of these companies, like if you study about Dixon Technology or Amber Technology or PG Electroplast, all these companies, they were nothing. They, nobody was talking about these companies, but now they have become the hottest stocks in the market. They, all these companies have given more than 10x, 30x return in the last 2 3 years. Why? Because government introduced PLI schemes. They invested a lot of infrastructure, and this kind of introduced a new sector in India, because at that time infrastructure, PSU, basically defense, EMS, these sectors were not existing in the market even. To matlab, companies were there, small companies were there, but analysts don't consider them as a sector because they were not useful. Like these companies never made return, PSUs never made return, right? So this was the paradigm shift that happened basically. So why India? So why invest in India? That India is actually today offering some great opportunities, which were actually happening when in the in the 20th century, when the American whole 19th and 20th century, when the American development was happening, and when the world power shifted from London to basically Washington DC. So such type of thing is happening today in India because of basically what happened is the highway networks in India have doubled, road network has doubled, internet broadband has tripled in last 6 7 years. Everyone has access to cheap data. There are payment technologies as UPI. What this all this makes is making doing business democratized in India. Like if you want to distribute all this your business, if you want to establish a distribution, earlier you have only one way of doing that, that you go and make distribution slowly through uh, basically retailers and wholesalers, you suppliers, you kind of get slowly. But today you can, because of all these new advancement that has happened in India, business doing is become much more democratized in India, and hence there is emergence of a lot of new companies in India particularly. And because there's so much emergence of earnings is coming in these companies, that's why there is a lot of development, these companies are booming, and that's why there was a lot of hype around mid cap and small cap stocks, because these are the companies which are like small companies which are now becoming big. So we will start about discussing some things about India, but only shortly. First is the rising per capita income. So if you see one chart here, basically this chart. So this is basically telling you the rapid GDP growth. So in COVID time 2020, -6%, and now the growth almost was 10%, 7%. And this is GDP per capita income, nominal, and purchasing power uh, adjusted of India. Even though you see India is doing great, but even though the per capita income is still very less in India, India is third largest economy if adjusted for the purchasing power parity. So this was some macro economics. If you now get into nitty-gritties of from where the growth is coming, the first thing is that India has a very strong GDP. The trend is good, strong growth happening in per capita income. Another is the emergence of something called as manufacturing hubs. Indian manufacturing is very strange that it is concentrated in just few towns of India, and I will show you subsequently. One prominent example is Surat, how the whole diamond industry, even the 90% of world's diamonds are polished in Surat. All the industry is just situated in one town. Like I will show you more subsequent examples. See this. We have Tirupur, a town in Tamil Nadu. If somebody is from Tamil Nadu, he might know that this town is a specialist in textile manufacturing, especially knitwear exports. And in this, it contributes nearly 80%. Matlab, think about it. This town basically don't have an airport. This town, I don't think it has a good railway station also, but it's contributing 80% to India's knitwear exports. There's a town called Kannauj in Uttar Pradesh, which specializes in manufacturing of perfumes. Small MSMEs here manufacturing perfumes on a large scale. Around 16% of the world perfume oil is the major ingredient used in making of perfumes and ittars, that is exported and manufactured in just a single small town of Uttar Pradesh called as Kannauj. Then there is Mysore. Around 70% of India's ESDM is manufactured in Mysore. If you talk about mobile manufacturing, India is the second largest mobile manufacturer today. Just a single space, the Bangalore to Chennai highway spaces, small companies around this highway which all do mobile manufacturing, and this spot is by far world's second largest mobile manufacturer spot. So all the manufacturing just of mobile phones, India's most manufacturing just happening in this around this highway. Then there's a town called Chikli in Gujarat, which do PVC solar modules manufacturing, and it caters to around half of India's PVC module manufacturing and around 2% of world's demand. Just a single small town in India. Hyderabad specializes in API manufacture, and it's a export hub, pharma hub of India, accounts for 40% of bulk drug and API manufacturing of India. Dahod, which is a very small town in Gujarat, it makes specialty chemicals. Around 20%, mind my friends, 20% of global specialty exports are happening through this town. Bangalore, which is the IT Silicon Valley of Asia, and Kolkata, which makes yearly 25,000 crores of wagons just from a single big city of India called as Kolkata. Then are there more. Morbi. It's a very interesting town. If somebody has been to Morbi, I haven't been, unfortunately. But this town, by the way, it's the ceramic capital of India, and soon it will become the ceramics capital of world. So here, tile manufacturing is done on a wholly different level. Tile manufacturing, you want, they will do. One of the best tiles and ceramic spots they make. Also there is a lot of wall clock manufacturing happening, and ceramics, like in ceramic sector, Morbi is like known worldwide. It's like an international export hub of ceramics. Rajkot specializes in reverse engineering. Hosur in Tamil Nadu makes automobile components. Around 35% of total automobile components just done in this small town of Tamil Nadu. Similarly, Ludhiana makes cycles. Jalandhar, a town, makes 70% of cricket bats. In cricket segment, 70% of production of the world, not India, is happening in this town called Jalandhar. Similarly, in firecrackers, this small town, Sivaski, catering to 70% of India's demand. And in food packaging, all the food packaging companies, they give contracts to manufacturers of Satara in Maharashtra. So the thing I want to tell you from this is actually all the manufacturing is getting like targeted, concentrated in few of these small hotspots of manufacturing. नाउ अंडरस्टैंडिंग द इंडियन कंज्यूमर. सो इंडिया का जो कंज्यूमर बेस है बहुत बड़ा है. इंटरनेट सोशल मीडिया की वजह से वो और बड़ा हो रहा है. ई कॉमर्स इज देयर, क्विक कॉमर्स इज देयर, क्रेडिट कार्ड के होल्डर्स नंबर्स बढ़ रहे हैं, बैंकिंग सिस्टम एंड फॉर्मलाइजेशन ऑफ द इकोनॉमी हो रही है धीरे धीरे. And but if you talk about India, India is a very interesting country in the sense that India's growth story, it actually is difficult to understand. Both the pessimist and optimist are disappointed. If you want to find optimism in this country, you will find, but then you will find a lot of bad things. And if you go to the extent of pessimism, you will also find good things. So this is the GDP growth of India, and India is like one of the hotspot for GDP growth for the world. So if you see, like COVID times were -6%, and we reach almost 10%, and now it is around 6-7%. And then the India's GDP, it is actually led by consumption, not investment actually. So 60% of India's GDP is actually private consumption. Consumption happening in households like us. We are consuming and that is contributing to the GDP. Unlike China's, where private consumption less than contributes less than 40%. So there, the gross fixed capital formation, which is a fancy way of saying how much investment capital is there. Uh, basically, capital basically there are two things. First, if you capital formation basically means asset formation. So anything which is consumed for more than 1 year, it is categorized as an asset. So all the machinery, all your everything in the asset space, that is the gross fixed capital formation. In India, it is just 29%. In China, it is 43%. So basically, India's growth is consumption-led growth, not investment-led growth. So if you see the why there is less gross fixed capital formation in India, it is because corporate India underinvest because the credit available to corporate India is less, and all the that consumption, sorry, that investment has to done by the government. So government investment become a very important driver for GDP growth in India. And this is the chart that shows how the India has consistently underinvested in capital formation, and that's why we are at 29% capital formation only, and worldwide it is more than 30 to 40%. If you see Indian consumption, if you see, we are talking about that 60% of our GDP is just consumption. We will think that India consumes a lot, but that's not the reality because we have a lot of large population. If you see, in many of the categories, the India's consumption is very less. If you see China, domestic air passenger yearly, it is 590 million. In India, it is 152 million. Elevator density is one of the lowest in the world in India. Per capita protein consumption is also one of the lowest in the world. And households goods ownership penetration, if you see in certain section like car and AC. So if you, by the way, if you have a car in your home, you are among the top 10% of India. If you have AC or cooler at home, you are among 25%, top 25% of India. And this starts us that what India is all about. So I will introduce a very interesting concept called as India 1, India 2, India 3. So basically, this is introduced by this venture capital firm called as Bloom Venture. It releases a report called as Indus Valley Report every year around India and tells some interesting insights how India is all about. So if you they categorized Indian population in three segments: India one, India two, India three. So India one is basically per capita basis. India one is similar to Mexico. It is the consuming class of India. It has almost 30 million households, 12 crore or 120 million people, and 15,000 per capita income dollars. It is the major consuming class of India. So all the D2C startups, they are targeting this India one. India 2 and India 3 actually doesn't consume much because they don't have the income for that. If you see the wealth distribution in India, it is very, very unequal. Like 1% of India has almost 39% of the nation's wealth. There's a lot of skewed wealth distribution in India. If you see the India 2, in per capita terms, it is similar to Indonesia. And the per capita of India 2 is around $3,000 per capita, comprises of 300 million people, and I think a large segment of internet users comprise of from India to only. And there is India 3, the which whose per capita income is less than $1,000 per capita, which is less than 80,000 rupees per year. And this is a majority population of India, a billion people we are talking about. So this is the stark inequality of consumption happening in India. All the consumption is targeted toward the India. If you see, only 1% of India's travel abroad. So if you have travel abroad, we are already in the top 1% of India. India just has 30 million broadband connections. Less than 30 million demat accounts we have, unique demat accounts holding more than 10,000 rupees in investment. Only 30 million households which own a car. Only 40 million unique credit card holders. Just 22 million taxpayers. Just 40 million mutual fund investors. So this is basically the stark difference that even though we have a huge population, but consumption of that population is very, very small to begin with. So, after understanding India, we will understand something about the things that led to India's manufacturing growth after COVID. That was the this scheme, which was very successful, called as PLI. It is called, the full form of PLI is Production Linked Incentives. So, in different sectors, government introduced the schemes and giving money to the companies, uh, provided they have met some production targets in and that production need to be happen in India. So, for example, this is like the sectors auto ancillary and auto sectors, these different sectors, and these are the FY22 profit after taxes. Sorry, and this is compare it with the PLI money they are getting. So auto ancillary, the PAT is 7,000 crore, but they are getting 26,000 crores in PLI. So this is the amount of money in the government is spending in this scheme. And that's why if you see all the manufacturing companies, all these new sectors that have emerged in Indian economy, they're doing so well because of this PLI scheme. You talk about rural India. Actually, rural India, which is lower per capita income India, there the durable and consumer companies do not reach. Only the FMCG companies basically target this. But now we are seeing like new companies like Voltas Havels, they are targeting because now the rural India is almost mostly electrified. And the penetration of these electronic goods is very less here, and that's why these companies are trying to capture this new, because they will now get into the buying these things. There is a narrowing gap between urban and rural consumption, if you see, and rural per capita is increasing fast. So what did we see till now? That India's response in COVID, government investment can leads to new sector even forming, can leads to significant returns for the companies, and household expenditure is also on the rise. So if you make your investment thesis around where the government is spending money, you will do good, right? This was all the motive of explaining all this story until now. So we will now talk about some frameworks for investing. The first framework that we will going to talk about is the 100x framework or 100x formula. basically which tells which company has the potential of giving you 100x share price. So the formula it has basically helps you identify high growth companies. So a company which will give you 100x, obviously it will be available at cheap valuation now, and you can able to sell it at a higher valuation. And the most important thing this company will have, it has a higher earnings growth and sales growth. So the growth is very important in investing. I think growth is the Gayatri mantra of investing. So if you want to capture such kind of company, the first segment will be you have to go for high growth companies, 30-40% growth where it is coming. So you have to get from the sectors where high growth is coming. Like for example, in India, EMS is doing high growth, solar is doing high growth, transformer sector there's a lot of growth, hotels there is a lot of growth. So there are emerging these sectors where a lot of growth is there. Then you will see it cash flow from operations. Just sales growth is not enough. Earnings and cash flow should be there, because if there's a very important ratio, if you like to note it down, it is CFO to earnings, basically CFO to by net profit. It should be more than 50%, because if it is less than 50%, what does it tells us? That basically company is making money, it is generating income, so, earnings, but it is not able to convert that earnings into cash flows. Cash flow basically means the real cash coming in the business. Then the second part is the return on equity. So return on equity formula is basically net profit divided by the equity or the book value. Book value basically assets minus liability. So a high ROE tells you the efficiency of the business model, how good is the business model. So generally, a high ROE company usually have good cash flows, because the high ROE tells us the quality of the business. Then the other thing is basically return on capital employed. That should be more than 12%. Return on capital employed formula is EBIT you do, earnings before interest and taxes, you divide it by the capital employed in the business. You get the return on ROCE, or the return on capital employed. Then you do trailing cash flow from operations, 12 months trailing, divide by the market cap. Ensure the number is greater than 15%. That signifies that you are buying at a correct valuation. Because why valuation is important, because if you buy a company at 100p, it basically means that there is no growth. You will get back your money in 100 years. Obviously, if growth is there in the different scenario, then there's concept of peg ratio, or the price earning divided by the growth. So basically, if you divide the P ratio by the growth of the company, you will get PEG ratio. And according to basically Peter Lynch, who introduced this concept of PEG ratio, the PEG ratio should be 1.5. In India, we will not find good companies less than 1.5 PEG ratio. So even 2 is good enough. So basically, it means that if 30% growth is there in the company, you should pay at max 45 to 60p. Then the important other thing is consider, considering margin expansion and sales growth. So basically, how margin expansion is done? Basically, it is done when basically your sales is improving, but your earnings are improving even more. That means that your expenses are reducing matlab, basically your expenses are not increasing that much as compared to how your sales is increasing. That is basically margin expansion. So basically, there is something called as economies of scale. How whenever a business scales, it costs come down basically. So, and this is also called the operating leverage in a business. Operating leverage means that when a business which is scaling itself, it gets leverage. Basically, what it does, that it is able to make more earnings with less sales. Basically, the margin expansions happen. The very important part about investing is basically valuations. And how do you determine valuation? There are different terms, one different ratios. One could be EV to EBITDA, when you divide the enterprise value of the business by the EBITDA. The other is P ratio, where you divide the price of the stock by the EPS, or the earning per share of the stock. The other is price to book, where you divide the price of the stock with the book value. Basically, book value is assets minus liability. The other is basically the PEG ratio, which we discussed about recently. Uh, these are basic valuation parameters. There are techniques of doing valuation. One is DCF, discounted cash flow, in which what you do basically, you find out value of the company through lifetime cash flows. So basically, what is the value of the company? The present value of the company is the discounted value of the lifetime cash flows. This is the most significant part of valuation, because what is the whole philosophy of value investing? That the value of a business is more than the cost you are paying for it. So so the value should be more than the price, because the price is what we pay, value is what we get, and value is difficult to determine because value is more subjective. So in valuation, buying stocks at reasonable price is essential. But reasonable price also determines on the kind of business. Some business are so good businesses. How we determine the business is good? Firstly, it should have a high, strong moat. Moat basically means the kind of a competitive advantage. The other, it should have always be making high return on capital and high return on equity. And the third thing is something that's the brand value of the business. So this is a good business, and obviously, good businesses you can justify a premium paying for them because they will generate higher growth. But the most important thing, even the business is good, because even it has a very good competitive advantage and it has high return ratios, high ROE and ROC. But still, if they cannot generate growth, then we also cannot pay a premium for a business. So all the things should be good. The growth should be good. The business quality should be good, and the management should be good. It should have a strong competitive advantage or a moat. Then you can even justify paying a premium. Understanding the valuation in terms of assets is very important. That how much asset the company have, and hence price to book analysis is also important. Also, there is one more concept in valuation called as reverse DCF. So a DCF is forward looking, in which basically you calculate the future cash flows and you discount those future cash flows back to the present value and calculate the intrinsic value of a business. The reverse of this, because there's a very famous quote by Warren Buffett that uh, basically if you cannot solve a problem, just revert the problem, basically reverse it. So reverse DC, basically what you do, you basically defines, for example, if you are buying a business, let's suppose you are buying Varun Beverages. Varun Beverages is a very high quality franchise, but currently it is trading at 90p. So you will determine, okay, so after 5 years, I will be able to sell it at an exit multiple of 50p, and currently my multiple is 90p. Then I expect, for example, at least 15% CAGR from it, basically return, investor return. Then if you want to do this, if you are buying at 90p and if you want 15% CAGR, when you know the exit multiple can be hardly 50, then if you do a reverse DCF, you can calculate the earnings growth that will be required by the business. So after doing this, you will find that okay, for achieving this, this business need to do 25 to 30% earnings growth. So you will ask yourself, if you want 15% CAGR, this business need to do 30% earnings growth. Then only you will be able to make 15% CAGR. So this is kind of giving check on your expectation of a business when you are buying it at a higher valuation. So hence, doing reverse DCF is very good. On Tijori Finance, basically there is a feature of doing reverse DCF. So if you want to calculate, do basically reverse DCF, you can go to Tijori Finance and do this. One more important thing is understanding growth and understanding value and understanding return on equity. So basically, the maximum permissible growth for a business without taking external capital is basically related to the return on equity. So basically, we will see subsequently the formula. It is the formula is basically return on equity one minus retention ratio. So basically, retention ratio means how much dividend the company is like giving. So for example, company is giving 20% dividend and the return on equity is 30%. So you will calculate 30% multiplied by 1 minus zero point 0.2, which is zero point 0.8 multiplied by 30%. Almost 24% is the maximum growth a business can do without getting external capital. So you understand how much growth is possible. Because example, if we have seen also last time that even if the growth of the business is very good, uh, then also returns can be compromised. The return on equity is very less. So growth has to be compared with the return on equity. Very important. So we discussed about this, that buying at correct valuation, and what is the correct valuation at which you have margin of safety basically. There should be difference between the value and the price. The value of the business should be greater than the price of the business, and that is basically the whole margin of safety. So these are some companies which got in some niche players and they were able to create a lot of wealth. Example means Eicher Motors, which sells basically bullet bikes, TTK Prestige, in which it is a market leader in pressure cookers, Symphony, which was pioneer in air coolers, Imami, which was a niche consumer brand selling basically hair oil and fairness creams, Shriram Transport, which was pioneer in truck financing. Basically, it was an NBFC. Gru Finance, which was a leading player earlier. Later, Gru Finance basically merged with Bandhan Bank, but earlier it was a subsidiary under HDFC Bank, and it was a NBFC which used to do mortgage-based lending basically. CRISIL, which was a credit rating. So these all these companies they were operating in a very specified niche, but they have a lot of moat in terms of their business competitive advantage, and that's why a niche company even operating in a niche market, but it has a significant competitive advantage, can make great wealth over a period of time. Another important framework of thinking about wealth creators is the concept of value migration. And what does value migration means? Value migration basically means that you are shifting the value basically, or the earnings are shifting, migrating from the outmoded business designs to new ones, which are better able to satisfy customers. A very important example of value migration can be the whole conception of smartphones. So earlier there was a company called as Kodak in USA, and it was like a really large conglomerate, really large company. But this company cannot not does not exist because why? It used to manufacture analog cameras, but now with the whole introduction of digital cameras and subsequently smartphones, the value whole migrates, the industry whole changes, and there was value migration toward digital cameras and smartphones, but this company was not able to adapt to the value migration that was happening, and the companies which are able to adapt with the value migration, they create a lot of wealth. Like there are so many examples of all these stocks which went to be 100 bagger stocks, means that they give 100x returns. So a 1 lakh rupee became a 1 crore rupee in these stocks. If you see, most companies are non-commodity companies, these are not cyclical companies. Like, and many of them, they're due to value migration that happened. For example, take the example of all these private banks, HDFC Bank, Kotak Bank, Axis Bank. They created a lot of wealth. The reason was that all the value migrated from the public sector banks to private banks. Earlier, before 1991, there was not much. All the banking, basically market share was with the public sector banks, but because public sector banks were inefficient, their service were very poor, all the value migrated towards the private banks, and hence the wealth was created not by the public sector banks but by these private banks like HDFC and Kotak Bank. Similarly, the whole value migrated towards technology, IT companies, and so Infosys, Wipro, KPIT, all these companies, TCS, they created a lot of wealth. Similarly, in healthcare, all those segments, Sun Pharma, Dr. Reddy, Cipla, Lupin, Glenmark Pharma, Aurobindo Pharma, Ajanta Pharma, they created a lot of wealth. So this was the whole concept of value migration. Similarly, in jewelry, basically the value migrated from the unorganized sector to the organized sector. Earlier, all the jewelry sold in India was unorganized, but later the value migrated towards organized sector, and Titan was able to capitalize on that. The other segment where 10x can be made is consumer facing dominant businesses which have a lot of brand value, and they have a very good competitive advantage. And these are all these businesses like Asian Paints, Pidilite, Blue Dart, Amaraja Batteries, Havels. All these businesses, these are consumer facing businesses, and they have a very strong moat or a competitive advantage, and that's why they are able to subsequently kill competition and able to maintain their dominance. Although Asian Paints dominance is now challenged by Birla Opus, and we will see subsequently like how Birla Opus is able to challenge Asian Paints dominance in this whole industry. And hence we understand one important thing, that even valuation understanding is not enough. A very important thing about investing is understanding the business models. A good business model coupled with a good management creates a lot of wealth. Example, Titan, Asian Paints, all these are for good business models. They have a great management, and that's why they were able to create a lot of wealth. Even A very good management with a okay business model can create wealth. Like for example, banks is not a very good business model, it's a okay business model, not a bad business model, but with very good management. In terms of in HDFC Bank, the management was in terms of Aditya Puri, and in the case of Kotak it was terms of Uday Kotak, basically. Very great management. So understanding management and understanding business model is very important. Like for example, in the steel sector, Tata companies, most companies have created good wealth. But if you see Tata Steel, if you analyze the last 20 years, it hasn't even beaten inflation basically in its returns. Because bad sector, bad business model. Steel is a cyclical sector. Selling steel is a bad business. Why is it it's a bad business? Because it's very difficult to make money subsequently. Because there are commodity cycles playing here. If too much supply of steel comes in the market, the price of steel crashes. If there is very little supply, the prices of steel go up. So the margins keeps on fluctuating. That's a bad business model. And how do you understand the business model? By all these things. You understand the revenue sources, you identify the competitors, you you identify which are the major customers, what is the basically the moat or the USP of the business. You understand the whole framework around the business, you assess the strength and the weakness of the business, you identify growth potential, because if there is no growth potential, how will the business survive? Like, because growth is the ultimate thing in India. If you are like not able to deliver 12% growth, because that's the nominal GDP of India, then what you are doing exactly? So for example, if you are looking at some, you have to look at companies which are shark in a blue ocean. Blue ocean means a lot of scope for growth. Like for example, if you see Bajaj Finance till now also even doesn't have 5% market share in its lending category, even though it's the most dominant NBFC of India, because it's a very big market. So there's a lot of room available for growth, a lot of growth potential available for that business. But there are businesses in which you yourself become 70-80% of the market. For example, in Asian Paints, you are 60% of the market itself. How much you can grow more? So looking for growth potential in the business model is a very important thing. Then looking at the financial performance, and financial performance, how do you do? Looking at the basically the growth in terms of the revenue growth, the earnings growth. Is earnings converted to the cash flows? So you look at ratios like CFO divided by the EBIT. To understand that, you look at the P&L, you look at the balance sheet, and you check about it. And also there are qualitative factors to look in a business model, which is the management of the business, which is the jockey which is running the horse. Because if the management is poor, even a good business model fails. For example, Vijay Mallya, basically, alcohol is a very good business, a good business model in terms of alcohol. But management was bad. Vijay Mallya destroyed the business. Similarly, Kingfisher Airlines, bad business. Airlines is a very difficult business to operate because the costs are so high. And bad management in terms of Vijay Mallya destroyed the business. So that's why understanding business model is very important. Another framework is quality growth and longevity at reasonable price. So first thing is the quality of business. And how do you determine the quality of business? First thing is the management. Second thing, it should be a stable business. Third thing, it should have high opportunity. In terms of the business is very sorry, the target market is very huge. There has to be a moat, a competitive advantage, and the financial should be healthy, high ROE, high return on capitals. The second thing, in the business, it should be available. Even the business is very good, but it should be available at a reasonable valuation, at a reasonable price, so that you have some margin of safety. The third step is the growth. Even the business quality is good and you get it at a good price. But if there is no growth, the money is not made. The money is made only through growth. So growth should be everywhere. Growth should be the volume of the product. So for example, if you are selling like cold drink, Varun beverages, so the how much volume it is able to increase subsequently should be more. Growth should also be in terms of price or earnings. So growth is very important. The fourth thing is the longevity segment of the business that we typically forego. But the company has a competitive advantage, but for how much time it is able to sustain that competitive advantage, which tells about longevity. For example, in tech businesses can be easily be like a new technology comes and they disrupt the old industry. For example, in US there was a company called Check, and you college and school students used to do their homework through check. But suddenly in 2022, when OpenAI launched ChatGPT, the whole market shifted. The company was killed suddenly because there was a new technology that emerged and the old business got died out. So there should be longevity in the business. Now we will gonna discuss a very important concept, which is called as basically variant perception. And this is a very good quote by Howard Marks basically that to take advantage of divergence, you have to think in a way that departs from the consensus. You have to think different and better. This goal can be described as second level thinking or variant perception. So basically, thinking of consequences. And that is basically variant perception. You have a different perception than the whole consensus because you are thinking of one step ahead. And that is all about variant perception, and we will discuss how to apply variant perception in investing. If you want to study more about this, there's a very good book called Blink. It's written by Malcolm Gladwell and talks about pattern recognition. So basically, in this book, in the initial part, what they have done, they've analyzed many of the top performers, and they analyzed that these top performers had an innate ability in their field. They developed this ability of pattern recognition. So very good book. Also discuss in the subsequent part about second order thinking of higher order thinking. So a must read. So now coming to variant perception. So basically variant perception is you having a different perception from the market. So there are various mental models in variant perception. These are all the mental models. One is margin expansion, other is operating leverage, other is demerger. Then we have management change, industry cycle, cost reduction, capital expenditure, product mix change, deleveraging, corporate action, and we'll see subsequently. But the basic theme of variant perception is that the market is thinking in some certain sense, but you have a different insight, a differentiated insight about the business, and this can be out of all these things. Maybe you know that the management of the business is going to change and a new management, which is a more competitive management, competent management, is going to come. So the market is not able to discount that thing in the price because you have a differentiated business insight, and that is basically variant perception. And we will see some case studies and examples of variant perception, how they can be applied. Very good example of the first segment of variant perception is basically in the case of BKT or Balakrishna Industries. So basically, which variant perception here we are talking about? It is basically cost reduction or margin expansion. Similar, that either you are able to reduce your cost or somehow you are able to pass on your cost to the end consumer. In total, you have to expand your margins. And this was done beautifully by this company called as BKT. BKT is Balakrishna Tires, and basically there are two types of tires. One is on the highway, second is off the highway tires. Basically, this company makes off the highway tires of tractors and all those things. So basically, one is the consumer segment of the tires is like tires made by MRF and Apollo tires, etc., which are there in the cars, etc. Other is tires made by BKT, and these in this industry basically personalization and customization is very important. And because labor cost is very low in India, this company, if you compare it with all its international competition, it has the highest return on capital. It makes the most money, and it manufactures these off the highway tires at the least cost. There are different things. The manufacturing at the least cost is basically the competitive advantage of the business, and that's why the return on capital is high. The ROE is also the highest. One more thing, subsequently, it did recently, well, not recently, around 4 5 years back, what it basically did backward integration in carbon black. So carbon black is a very important, basically raw material utilized in making of the hybrid of tires. And basically, this company did backward integration and also install capacity in factories to make carbon black. And that's why the raw material they are making themselves. So that's why they are able to reduce the cost even further, and then hence their margin expanded. So what happened in the industry in 2012 to 2016? The industry was in a slowdown. Industry cycle was such that, and most of their competitors were getting bankrupt. And at this time, if you see their volumes, they were stagnant in this phase 2013 to 20 15, sorry, 2016, these 3 4 years. But then suddenly the industry recovered and there was an uptick in the industry, and now you see suddenly the volume expanding. So in this time when the competitors were like almost bankrupt, now when the good cycle came and the business revived still. The other mental model is capital allocation. And basically capital allocation is a very very important thing. You will see in the slide of capital allocation. So every business has finite amount of capital, and how the business allocates its capital comprises under capital allocation. So as a business management, you have different source avenues of putting your capital. One could be starting new business segments. One could be that you are making more and more acquisitions. One could be that you can repay your debt, basically or called deleveraging. One is you can invest in building capacity, in building factories, basically doing capex. You can spend that money in research and development. You can spend that money in advertisement. So basically, where do you exactly spend your money? That comes under capital allocation, and this is a very good variant perception. And if you know that the capital allocation of the business is going to improve, then you can apply this variant perception on the business. Let's see a case study. And the case study is basically ITC. So ITC, what it did, that a company would pay 80 to 85% of its tax back to the as dividends. So basically, they de-invested their money, which they were spending in the hotel segment of the business, back to the shareholders. And why it was a very good move? Because actually, if you understand the whole the business of the ITC, all the money of ITC is made through their cigarette business. ITC is a conglomerate and they have different business. One is their agri business, other is their packaging business, other is their real estate business, then they have a hotels business, then they have a FMCG business, and then they have a cigarette business. All the money is made in the cigarette business and hotel business. They are bleeding money. So earlier the management allocated the money to the hotels business, and they basically destroyed the capital. But later, management decided that they will give back the money to the shareholder itself, and that's why the lot of wealth created for ITC in that 2021-2022 period when everybody was mocking ITC, and the stock agreed doubled from 400, sorry, from 200 to 400 rupees. The other mental model in if you see here, so this is the chart containing year, sales, capital employed, turnover, margins, and ROCE in the FMCG space. If you see, similar to hotel space, where they don't make any money and loses money, in the FMCG business also, they are making just 4%, 3% return on capital basically. And the EBIT margins are abysmally low. On employing 6,000 crore of capital, more than 6,000 crore of capital, they are able to just make EBIT margin of 3 crore. They are not making money in their FMCG business and their hotels business. And that's why that move in 2020 at ITC made was very good move. Because basically the company analyzed their mistake and basically corrected that mistake and basically improved the capital allocation. If you see one more thing, एक second. One more thing in ITC was that basically was demerger happening in ITC. So ITC was said that they will demerge their hotel business. So demerger news I think came sometimes back, and I think demerger will be happening for sure now. So what demerger happens in a demerger? A very good example, ITC, apart from ITC of of business demerger is Suven Pharma. So there's a concept in business called as when the bad, good, and ugly business trade together, the valuation of given to the businesses of the ugly. For example, in a conglomerate, if there are different companies, that conglomerate will have something called as a conglomerate discount. That means that if you demerge all the business entities, then you will unlock more value. For example, in Reliance Industries, they have different businesses. They have retail also. They have the telecom business also. They have the basically the oil and petrochemicals business also. But if you individually value each business, they will subsequently cross the valuation which is given to the whole conglomerate as Reliance Industries. So every conglomerate has this called as the valuation conglomerate discount, and this is basically done because valuation in such a case is given of an early business. For example, the Suven Pharma, there are two businesses. One is the R&D business, and other is the drug business. The drug business is a super profitable business, and but the company spent a lot of money in R&D basically. In all this time, 2015, 2019, they spent a lot of money in finding some drug, and they were subsequently not able to find this drug. and that's why the valuation given to Suven Pharma was very ugly. But then what they did, they basically demerged this business of biotechnology in which they were doing R&D, and then Suven Pharma became a multi-bagger because now the ugly business has demerged. So the prime business will get a much higher valuation because earlier it was like there. The other value variant perception is understanding value chain. It's a very good quote, basically by Peter Lynch, that whenever, like in a gold rush, the most money is made by the shovel sellers. So basically, it was came this incident came from the story from basically California, where in California gold was found. So everyone came to like dig gold in these gold mines of California, but only few people money make money in this gold rush, but the most money was made by all these players like shawl sellers, which were actually facilitating these gold miners. So if you understand the value chain of a business, and if you see that the front client is having a lot of sales growth, so unless buying that front line, you can just go back down the value chain and understand a very good player which is gonna supply these things to the client. For example, if you are like confused between two companies, like in automobiles, for example, in Tata and Mahindra, you are confused. You can go to a supplier who supplies material to all these companies and which is going fast and which is very good in value chain, very important in the value chain. One more example of this in the API and the pharma and chemical industry. After COVID, the chemical industry, the pharma industry, and the API industry basically did very good. And what happened is during this, if you understand the value chain of this industry, there was a requirement of basically amines and glass lining equipments. And glass lining equipments, only two companies of India make glass lining equipment. One is GMF Fodler, another is was HLE Glasscoat. And amines, only two companies make amines in India. One is Alkai Amines and other one is Balaji Amines. So rather than buying basically API manufacturer or pharma companies or chemical companies, what you could have done is bought these companies manufacturing of glass lining equipments or manufacturing of amines. And you will see that these companies, actually Glasscoat, Alkyl Amines, and Balaji Amines, made a lot of money during after COVID this period. They did 5x, 10x the wealth. This is the whole variant perception of basically understanding the value chain. One good example was in the whole EV industry, there is a requirement of something called as a shunt resistor, and there is a company which makes shunt resistors. So you can rather than investing in EV, you can just bought this company who makes shunt resistor. Other is margin expansion, which happens in the case of Alchem Laboratory. So Alchem Laboratory basically makes drugs, and in medicine basically there are two types of therapies. One is the acute therapy, one is the chronic therapy. Acute therapy means that आपको कुछ पर्टिकुलर दवा मतलब बीमारी हुई और वहां पर आपने कुछ टाइम के लिए दवा ली और फिर वो खत्म हो गई. क्रोनिक मीन्स कि आप बहुत लंबे समय तक वो बीमारी चलने वाली है. फॉर एग्जांपल डायबिटीज, हाइपरटेंशन, इन सब में क्रोनिक थेरेपी होती है जहाँ पर लंबे समय तक दवाइयाँ चलती हैं. सो क्रोनिक थेरेपी इज मच मोर प्रॉफिटेबल बिकॉज वहाँ पर कस्टमर रिपीट है बहुत ज्यादा. कस्टमर का चर्न कोई नहीं, कस्टमर छोड़ के नहीं जाना ना, वो सेम कस्टमर बार बार आ रहा है. सो पैसा बहुत ज़्यादा क्रोनिक थेरेपी में बनता है. और बेसिकली एल्केम लेबोरेटरी ने यही किया कि बेसिकली अपना जो फोकस था R&D, वो अपना एक्यूट की जगह क्रोनिक थेरेपी पे लगाया. ज़्यादा इन्वेस्टमेंट वहाँ पे किया और वहाँ से उसका पैसा बना. तो वहाँ से उसका मार्जिन एक्सपेंशन हो गया बिकॉज क्रोनिक थेरेपी में मार्जिन ज़्यादा थे. The other variant perception which can be used in continental coffee. So continental coffee basically, if I explain you the business, basically it if you see the value chain of the whole coffee industry, it is first there are coffee plantation in which coffee is harvested, good quality beans are extracted. Then there is processing of coffee. Then it is dried, the beans are milled, then they are roasted, and finally the brewing happens of the coffee. The most important step which gives the identity to the coffee is basically processing of coffee, which is the step number 3, and this is done by the continental coffee. So it is like example of value chain analysis where you understand the value chain and understand, okay, this is a very important player in the value chain. So what happened in this business was actually they are making different types of products. One is spray dried coffee, one is spray dried agglomerated coffee, one is freeze dried coffee. Actually, in all these segments, the most margin there is, it is in the freeze dried coffee segment. This is the most expensive form of the product line in their whole product line. So what this company Continental Coffee did, it announced basically capacity expansion, decent capacity expansion in this. And because of this, because they expanded their capacity, they were able to sell more of this. And because it has much more margin, it increased the margins. And this was a variant perception into play, was product mix change. If you are moving up the value chain, you are selling products which have a higher margin, and you're doing that instead. If you are changing a product line in such a way, then it's a variant perception that you can use. So another example of the same variant perception was Naveen Fluorine. So earlier, Naveen Fluorine, when the business started, it used to make inorganic fluorides and refrigerants. Naveen Fluorine is a specialty chemical company, right? So they used to make this. But then after some time, they moved to the specialty chemical segment, and now they are in CRAMS and high performance product segments, basically. So this is like transformation of a business where the business is climbing up the value chain and moving up to the more value segments, like doing product mix change, basically. So this is a mental model you could have identified Naveen Fluorine, which was a great wealth creator because it was moving up the value chain into specialty chemicals and CRAMS. CRAMS is basically custom research, basic manufacturing. So, so these companies, they do research and they manufacturing the manufacturing part to companies like Naveen Fluorine in the fluoride space. So this is the business units. Earlier they were in refrigerants, then inorganic fluorides, then specialty chemicals, and now 2011 they get into CRAMS business. So it is the business is like moving up the value chain, and they are introducing the basically the segments which are much more profitable. The other variant perception was management change. So in Britannia, what happened in 2014-15, there was a management change happened, and this is the new management. They what they did, instead of they understood one thing, that in order to make money, FMCG, either you should sell your product to more customers. That means that you are increasing penetration, or either you sell more to the existing customer. That means that you are increasing volume per customer. Or third thing is that you are selling better product to the same customer. So what the management realized that in India they have exhausted the market in terms of the penetration of biscuits is too much. Also, a person as it gets much more per capita income will not like suddenly consuming more of biscuits. But what it will do, it will premiumize itself. It will buy earlier they will buy Parle, then they will buy like cookies, expensive cookies. So when person get rich, they will not consume more, but they will consume better. So this was the insight that was like taken by the management of Britannia, and they premiumized their whole product portfolio, and hence started offering premium things, and hence their margin expanded. And if you see the operating profit margin of Britannia, it like zoomed like from 7% operating margin that they were making in 2013, now they're making like more than 16% margin, 17% margins. So this was the mental model you can have operated of management change. A very important mental model is P ratio. P ratio not only tells about the valuation of the business, but it actually tells about the perception of the business. For me, P ratio is actually perception about upon earnings. Basically, the P part is actually the perception. How and the P re-rating can happen, de-rating can happen. The P ratio can change based on the perception of the market. Earnings, although earnings of the business was constant, but the perception of the market changed and the stock did got into a different trajectory. So hence understanding P, your entry P multiple, your exit P multiple, P rating, P de-rating is very important. It's crucial. Similarly, how we studied about there are antithesis pointers to your thesis. One can be if there is corporate misgovernance. That's a red flag. Second, it is the opportunity cost of a business if the business is misutilizing it. Third thing is the business is facing headwinds. Like the industry cycle has changed in such a way that the business is now facing headwinds. The fourth is can be the opposite of margin expansion, which is margin contraction. Which is something their raw material prices increase and they are not able to pass down the increased raw material prices to the final customer. Basically, the margin contraction has happened. The fifth antithesis pointer is that you buy a business at peak margins and peak valuations. And the sixth thing is there is increasing competition on supply side. For example, what is happening today in the paints business? Every player is going into paints business. JSW is going into paint business. Birla Opus is going into paint business. Pidilite is going into paint business. What it is happening? It is increasing the supply side of the basically the value chain. And if you increase the supply, ultimately the prices have to be dropped, and then the margins made by the existing companies will drop. That's what Asian Paints is facing all about today. So these are the antitheses which you face in businesses. Very important is how much is the growth rate can be. If you do not, if you want the growth to be without raising subsequent money and capital, it could be retention ratio into ROE. And retention ratio is basically retained earnings divided by the total income. Retained earnings is basically earnings excluding the dividend and all. These are some of the valuation ratios you can see. If you don't know, EPS, earning per share, is net income divided by number of shares. P ratio is market price divided by the earning per share. Dividend yield is dividend annual dividend by share price. Payout is dividend per share by earnings per share. Book value is net worth by number of shares. Price to book is market price divided by the book value. These are some valuation ratios which we use. And also PEG ratios there in which you divide the P ratio by the growth. This is the industry life cycle. So every industry goes through this. There is a segment of introduction when the industry just introduces itself. Then there is a growth phase. Then there's maturity. Then there's a decline. For example, in the artificial intelligence, till 2021, 2022, we were in the introduction segment. Now we are in the growth segment of the business. But in some businesses, like for example, cigarettes, we are in maturity to decline phase because this whole phase has been so similar to how there is a person's life cycle in which there is infancy, adolescence, mid age, and then finally old age. Similar to the same happens with the industry, the same happens with individual companies. So it is very crucial to identify companies in the introduction and the growth phase and ride on this growth and maturity phase and sell at the end of maturity phase, because if you go into decline phase you will face a painful death. Very important thing in investing is the whole concept of numbers and story. The one portion of investing is understanding the story, the understanding the narrative. The other segment is understanding numbers. Whatever story are you claiming, is it backed by numbers? And there's a very good book called Factfulness. We basically explain that the world cannot be understood without numbers. So whatever story that you are telling, that for example CRAMS business will do good because China plus one will happen, or basically specialty chemicals will do good because of China plus one, or maybe EMS manufacturing because of PLI will do good. Okay, these are stories, but back them with numbers. Like, is the basically earnings of the company increasing? That is very important in investing, that your story should be backed by numbers. The other thing is, because ROE is the most important thing in investing because it tells about the quality of the business, is basically getting the feel of where the ROE is basically coming from. So this is the whole process of analyzing ROE is called dew point analysis. And in dew point analysis, what you do, you break down this ROE. Basically, what is ROE? It is net profit divided by the equity. So you basically what you do, you divide multiply by sales and divide multiply by total assets. So you get these three fragments. One is net profit by sales, other is sales by total asset, the other one is total asset by equity. Net profit by sales is basically is a net profit margin. Sales by total asset is basically what? Your turnaround. Your basically sales turnaround. But how much sales are you can do on the same asset? Basically, on the same asset, how much you can utilize to basically churn the cycle and like do more and sales over it. For example, for employing 1 rupee, by employing 1 rupee asset, you are able to do 3 rupees of sales. That means that your basically turnover ratio is basically three. On that 1 rupee of asset, you are able to do 3 rupees of sales. That is basically what is asset shifting is all about. Then asset divided by equity, which is basically leverage ratio. So basically, even by taking a lot of debt, you can increase your ROE. So, for example, in finance businesses, it is the case that this portion, if you see the first two segments, net profit by sales multiplied by sales by total assets, basically sales cancel out, net profit by total assets, you get the return on assets. So, in banks, the return on asset is 1-2%. Then you basically banks are leverage entities, so there is like 7-8 times leverage. Then you get the ROE of 15-16%. So, very important is how you are getting the ROE. For example, in case of DMarts, DMart ROE is very good, but their profit margin is very less. That net profit margin, that will be 7, 8, 7, 6%, but the ROE is 20% because the that turnaround is very good of the same assets. They are utilized more and they are doing able to do much more sales. So sales by total assets is around three there. In banks, it is actually leverage ratio, the total asset by equity, which tells us the leverage ratio. That is more. So finally, we are near the end of this whole thing. Some word of business, some like things to consider. The first is diversified business. Generally, we have seen that all the wealth creation has happened in concentrated businesses. Concentrated it means these are focused businesses. For example, Asian Paints, it has been in the paints industry for the last 40, 50, 60, 40 years. That is called focus. And even you want to introduce new segments because that's how, if you like exhaust your old market, you have to go into new market. You go into adjacencies. So generally, we are seeing that conglomerates and diversified business be cautious of them because they tend to perform poorly. Focused business does better; they get a better valuation. If the business are demerged, then it's a different case. For example, ITC demerges itself, then it's good. But generally, diversified business does poorly. If diversification is in the focused and related segment, then it's good. Diversification is good even then. Play close attention to what management is doing. And the hack towards this is basically reading annual reports. So every company by law has to publish annual reports annually every year. In that annual report, there is this one section which is called management discussion and analysis. Read the discussion analysis, basically that part. In that, you will get the commentary of the management, what management is thinking, what the guidance they are giving, growth guidance and revenue guidance, and the targets that they give, that we will be able to do this. Read the 15 years of management discussion analysis segment and you will find how consistent is the management. Is the management able to do what it is like promising? So that can be a very good analysis for the management part. The other thing is that buying, if you buy overvalued assets, you will never gonna make money. So, because doing DCF analysis is very difficult, because just change the growth rate by simple, just change the discount rate by 0.1%, the whole intrinsic value changes, and you are not able to like calculate the future cash flows or future earnings. So if you this is the problem. Basically, the solution is simply inversion. Reverse DCF is much better method in which you can analyze your expectations baked in. That if you are buying this business, if you are buying business at 100 multiple, then what are your expectation exactly are? So then you get into whole thing. Okay, for this 100p business, the business had to do 40% growth for the next 10 years to make money, just 15% CAGR. Then you understand that what are the expectation you are making in the business. Is the business gonna able to do 5 year 10 years 15 30%, 14% CAGR? You will get the answer yourself. Another thing is that whatever you do should be backed by solid research. The numbers part we talked about, the stories are good, but the story should be backed by numbers. So look for numbers. The other thing is consider trade receivables and the discounting by banks. So what happens is that, for example, there is net profit, but net profit, it is not like converting into the cash flow, which we talked about, the ratio cash flow by net profit. If that is less than 15%, that means that what is happening, the lot of money is locked in the trade receivables, and this is a sign of danger. So look for these signs, and there are much more. If you do forensic accounting, you will get to know about more of these things. That that the account should be good. So one of the way is looking at the trade receivables. If there is too much trade receivable in the business, there's something wrong in the business. Leave that business. So this was all about this. If somebody has any question, he can ask.
Hello. I had one question. You talked about consumption-led growth, and you also mentioned one word, investment-led growth. So, could you explain that?
In terms of economy or what?
I like. I was not very clear, like what consumption-led growth means and what
Okay,
investment-led
so
growth.
basically, if in the economy, basically, if you look at the formula of basically GDP, it is basically consumption plus investments plus net exports, basically exports minus imports, and plus if you add to that बेसिकली क्या होता है, गवर्नमेंट एक्सपेंडिचर. So India's basically whole GDP is 60% is just consumption. Our GDP growth is mostly consumption-led growth. Our investment growth is very less. Basically, the investment part of the economy is basically called the gross fixed capital formation. It basically means the asset formation part of the economy. So asset formation can be done by private companies. They can make factories, they can make offices, they can make, it can be done by government also. They can make roads, bridges, infrastructure, etc. It can be done by people like us. So there are, one thing is called assets, the other thing is called consumption. So India is basically a consumption led economy, not a basically investment led economy. Or so the gross fixed capital formation in India is very less. It is 29% in India, which is like more than 40% in good in countries like China and US and also.
Okay, thank you. I had one more question.
Mhm.
I was facing a little bit difficulty in understanding reverse DCF. So,
Okay, okay.
like,
Let
could
let me share my screen. And just okay. Can you see my screen?
not now. Huh, now I can see that.
Okay. Let's do. So if you basically see the this segment reverse DCF. So basically, are you able to see this?
Huh, yeah, yes, I can see it.
Okay. So basically, the multiple of Varun Beverages is a very good company. The multiple is 92 P. Okay. So if you talk about for a 5 year period, if your exit multiple is the average of the industry P, which is like 40 P, so your exit multiple is 40, your entry multiple is more than 90. That means that you are implying that in a 5 year period, you need 73% earnings growth. This is what reverse DCF is. बेसिकली व्हाट इज डीसीएफ इज अबाउट कि तुम्हारी कितनी ग्रोथ होने वाली है, अर्निंग्स ग्रोथ, उसके बेस पर हम इंट्रिंसिक वैल्यू कैलकुलेट करते हैं, आज की जो वैल्यूएशन है. रिवर्स डीसीएफ में हम उल्टा करते हैं, हमको आज की वैल्यूएशन पता है, हमको है ना. हम क्या करते हैं कि जो हमारी आज की वैल्यूएशन है, बेसिकली वो क्या इंप्लाई कर रही है कि हमको कितनी अर्निंग्स ग्रोथ चाहिए अपने को एक बेसिक रिटर्न कमाने के लिए. दैट इज 73% इन केस ऑफ तो बेसिकली इट इज़ टेलिंग कि इतने हाई वैल्यूएशन से प्रॉब्लम क्या होती है कि आपको एक ढंग का 20-25% का रिटर्न कमाने के लिए, सीएजीआर कमाने के लिए कंपनी को 73% की अर्निंग ग्रोथ करनी पड़ेगी, जो कि बहुत डिफिकल्ट है। ओवर 10 ईयर पीरियड कंपनी को 27% की ग्रोथ करनी पड़ेगी, और 20 ईयर पीरियड के लिए इसको 13% की ग्रोथ करनी पड़ेगी। सो बेसिकली दिस इज द एडवांटेज ऑफ रिवर्स डीसीएफ, कि तुम्हें पता चलता है कि बेसिकली तुम्हारी एक्सपेक्टेशंस क्या है किसी बिजनेस से, जब तुम बहुत ज़्यादा हाई मल्टीपल पे खरीदते हो। समझ में आया क्या है रिवर्स डीसीएफ?
Yes, like a little bit. There is still a little bit doubt. But,
उसके लिए पहले डीसीएफ आना चाहिए। डीसीएफ आता है क्या ढंग से?
uh, not completely.
हाँ, तो पहले डीसीएफ से आना चाहिए, रिवर्स डीसीएफ क्या समझोगे फिर?
Okay. Thank you.
बेसिकली मैं समझा देता हूँ। देखिए, डीसीएफ में हम क्या करते हैं कि हम फ्यूचर कैश फ्लोज देखते हैं, और फ्यूचर कैश फ्लोज मतलब कि फ्यूचर में कितनी कितनी ग्रोथ हो रही है, उसके बेस पे क्या क्या फ्यूचर में कैश फ्लो आएंगे, और फिर हम उसको प्रेजेंट वैल्यू पे लेकर आते हैं, जो कैश फ्लोज की वैल्यू है। क्योंकि कॉन्सेप्ट ऑफ टाइम वैल्यू ऑफ मनी होता है कि फ्यूचर में जो पैसा होगा वो आज के पैसे की इक्वलेंट नहीं है, वो उसके उससे कम है फ्यूचर का जो पैसा है। उसको डिस्काउंट करते हैं प्रेजेंट वैल्यू पर, उससे हम बिजनेस की वैल्यूएशन कैलकुलेट करते हैं। बेसिकली इसको इंट्रिंसिक वैल्यू बोलते हैं। तो हम क्या करते हैं, डीसीएफ में हम उल्टा करते हैं। हम कहते हैं कि देखो, हमको आज की वैल्यूएशन पता है जो बिजनेस की है, जो भी बिजनेस की चल रही है। फॉर एग्जांपल, इसकी वरुण बेवरेजेस की 95 टाइम्स प्राइस अर्निंग पे मिल रहा है। हम क्या करते हैं कि हम बोलते हैं कि ये इसको अगर मुझे बेचना हो तो मैं मिनिमम कितने में बेच सकता हूँ फ्यूचर में। तो मैंने सोचा कि ठीक है, 30-40 पी में तो बेच ही दूंगा, मतलब एग्जिट मल्टीपल मेरा, अगर खराब स्थिति भी हो जाए। और फिर मैं देखता हूँ कि मेरे को कितना रिटर्न चाहिए। मेरे को रिटर्न चाहिए फॉर एग्जांपल 15%, 20% सीएजीआर का। तो उसके बेस पे मैं कैलकुलेट करूंगा कि इस बिजनेस को कितनी अर्निंग्स ग्रोथ करनी पड़ेगी। तो वो जो अर्निंग्स ग्रोथ हमने कैलकुलेट करी, वही बेसिकली रिवर्स डीसीएफ है। नॉर्मल डीसीएफ में हम वैल्यूएशन कैलकुलेट करते हैं, इसमें हमें वैल्यूएशन पता है हमको, हम उससे देखते हैं कि हमें अर्निंग्स ग्रोथ कितनी की चाहिए होगी इस बिजनेस को बेसिकली, हम मुझे रिटर्न देने के लिए। सो बेसिकली वो रिवर्स डीसीएफ होता है।
Okay. Like now I'm able to understand it.
एनी अदर डाउट किसी को?
Thank you.
तो फिर हम एंड करते हैं, ठीक है? तो ओके, सो थैंक यू एवरीवन। ठीक। सो अगर कोई डाउट वगैरह हो तो फिर पूछ सकते हो, मतलब कुछ मतलब चाहो तो फ्यूचर में ईमेल वगैरह करके ही पूछ सकते हो। ओके, थैंक यू। ठीक है, बाय।